We just talked about managing a high debt burden, focusing on strategies like the debt snowball and avalanche methods. But what if you're relatively debt free and ready to take a closer look at your investments? That brings us to another crucial part of our financial debug session: investment portfolio review. Let's imagine someone, let's call her Maria, who's been investing for a while, but hasn't really taken a deep dive into her portfolio recently. She's heard about market fluctuations, different investment strategies, and feels a little overwhelmed. This is where a financial debug session, like we're discussing, becomes incredibly valuable. Sam, in this scenario, how can Maria assess the performance of her current investments and pinpoint areas for improvement?
The first step is gathering data, much like we discussed earlier. Maria needs a clear picture of her current holdings, what she owns, how much each investment is worth, and how it has performed historically. Then she needs to benchmark those returns against appropriate market indices. For example, if she's heavily invested in large-cap U.S. stocks, comparing her returns to the S&P 500 can provide a useful yardstick.
So if her returns are significantly lower than the benchmark, that's a red flag.
It could be. It warrants further investigation. It might indicate that her chosen investments are underperforming, or perhaps her fees are excessively high, eating into her returns.
That leads perfectly into my next question. What are the key metrics for evaluating an investment portfolio beyond simply looking at returns? You mentioned fees, and I know terms like asset allocation and diversification are important. Can you unpack those for us?
Absolutely. Asset allocation refers to how your investments are spread across different asset classes: stocks, bonds, real estate, etc. This is crucial for managing risk. Diversification means spreading your investments within each asset class. You don't want all your eggs in one basket, even within stocks, for example. Finally, expense ratios, which represent the annual cost of managing a fund, can significantly impact long-term returns.
Even small differences in fees can snowball over time.
Precisely. A seemingly small 1% difference in fees can compound to a substantial amount over decades.
So, how can a financial planner help optimize a portfolio like Maria's to achieve those better risk-adjusted returns?
A financial planner brings several advantages. First, they can provide an unbiased perspective. It's easy to become emotionally attached to investments, but a planner can objectively assess whether they still align with Maria's goals and risk tolerance. Second, they have the expertise to analyze complex investment products and strategies. Third, they can help Maria build a personalized financial plan that integrates her investment portfolio with her other financial goals, like retirement planning or buying a house.
So if I understand correctly, a planner can help connect all the pieces of the financial puzzle, like debugging code to make it run smoothly. They look at the big picture, not just individual lines of code, or investments in this case.
Exactly. They can help optimize the whole system for peak performance.
So, to recap, evaluating your investment portfolio involves more than just checking your account balance. Benchmarking against indices, understanding key metrics like asset allocation, diversification, and expense ratios, and seeking professional guidance when needed are all essential parts of this financial debug session.
It sounds like a great way to take control and make sure your investments are working as hard as you are.
Absolutely. Your call to action for this week: take some time to review your own investment portfolio's asset allocation. Do a little research on different investment strategies. And remember, knowledge is power when it comes to your finances.